Big-scale stimulus measures announced in recent weeks have put Chinese equities back in the spotlight. So, is now a good time to buy Chinese shares?
If you want to trade and make a 20% return in 3 months, then obviously no, because the market pickup has actually been very strong, right? If you have a 3 to 5 year investment horizon, this is probably one of the best times to pick up on the Chinese market actually, because even on the valuation basis, China is actually not expensive. It's actually not even at fair valuation. It's actually slightly below fair valuation.
Year to date, Chinese markets have outperformed regional peers, with indices in the mainland and Hong Kong seeing significant gains. While the froth from a late September rally following Beijing's stimulus announcement has settled down, some say Chinese stocks are set for another uptrend.
I think the second phase would be more dominated by earnings recovery, expectation recovery. So we are hopeful to see some positive earnings revisions along the way in the next few months. By the year end, the Hang Seng Index has a high chance to reach 24,000, and for the CSI 300 Index to reach 6,400.
For the Shanghai Composite Index, experts say the potential upside could be anywhere between 30 and 40% in the next 12 months.
The indexes have declined steadily, but there remain many good trading and investment opportunities, particularly in the emergent industries, in the green sphere, artificial intelligence, EVs. These are all exemplars of changes that are taking place and opportunities that are there.
In case our expectation realize that there will be more policies to boost consumption, we think that the internet sector definitely benefits. And the other one would be the mass consumption stocks, for example, those in the beer sector, milk sector, or even sportswear sector.
But there's concern about the state of the Chinese economy. The property sector remains in the doldrums, with new home prices falling at their fastest pace in almost a decade. China is looking to revive growth, but the lack of details has kept some investors on the sidelines.
We are neutral at the moment, but we are actively reviewing our positions. But we do really need to see the fiscal measures come in before we think that you can actually invest on a medium to longer term basis. We think the fiscal deficit as a percentage of GDP needs to increase to about at least 4.5% to 5%. Then it will be possible for the Chinese economy to meet the 5% target. Because if your exports are not really picking up, consumption is not really picking up as well, then you need infrastructure spending.
That aside, UBS says China should still be a key part of one's portfolio.
You should have at least 10 to 12% of your allocation in Chinese equities, even if you're globally diversified. Because I think where the market is concerned, I think over the next 10 to 12 years, the Chinese economy will suddenly pick up more steam and become closer to the US where the GDP is concerned. So I don't think anyone with less than 5% allocation to China is doing himself justice where the portfolios are concerned.
Investors have the option of buying Chinese stocks traded in Hong Kong, in mainland exchanges, in overseas markets like Singapore and the US, where American depository receipts are listed.
In Singapore context, the easiest way, of course, is to look at the SGX ETFs. They have quite a number of them that are tracking the China indices, and which means investors do not need to invest overseas to get China exposure, and a lot of these ETFs can be denominated in Sing dollar, so therefore also reduces the forex risk that the investor may face. Depending on the index that you choose to track with a particular ETF, you may get different kind of exposure. For example, if you invest in Hang Seng Index, you will only get the Chinese companies that are listed in Hong Kong. You will not get A shares that are like Volatile, which is a well-known name in China. You will not get the exposure. If, let's say, you invest in an A50 ETF, you will not get exposure to Tencent, Alibaba, which are listed in Hong Kong markets. For foreign investors, the two classes of shares that most are interested in are those that are listed in Hong Kong, which are the H shares, and the one that are listed in US, which are the ADRs. Because these two markets are internationally recognized, and foreign investors tend to be more familiar with them.
A simple ETF that gets you exposed to an entire Chinese index, whether that's offshore or onshore, would definitely make sense. For long-term allocation purpose, we have always been advocating the high dividend stocks and those with buyback plans, and that should remain to be a core part of anyone's China portfolio.
When choosing which companies to buy into, investors should avoid firms that tend to beautify poor financials. They must also look at management borrowings and timely financial reporting.
So investing in trends may not translate to business profits and higher share prices in the long run. The reason is because, for example, in EVs, there's a lot of competition, so price wars is happening and they keep slashing the price. And second is because of heavier costs on R&D that will eat into the profits of the businesses as well.
Two more things to keep in mind: unpredictable government regulations that impact businesses and the long-term underperformance, and also the volatility of Chinese stocks and geopolitical risks arising from US sanctions.
China is not a market to be frightened of. It's a market to approach with care and with caution, but we would say that for any market. Understand that there are greater levels of volatility, and that's partly structural because market moves are limited to 10% per day. They lock, as we would say in futures markets, limit up and limit down.
I think as much as we are positive on the outlook of the Chinese equity in the next 6 to 12 months, we also have to recognize one structural characteristic of the Chinese equity market, in which retail participation is higher and also the so-called fast money participation is higher.
If you cannot stomach volatility of the kind of range, then maybe you should pare down your allocation towards China. But again, you should not be 0% in China. You can have exposure to the renminbi as well, to the Aussie dollar, to luxury stocks in Europe and in Hong Kong. Those are also other ways of getting involved with China or getting invested in China. So there are several ways of doing that. But again, don't let the volatility put you off. Because if you're there for the medium to longer term basis, you find that the market will always work in your favor. But if you're there just for 2-3 months trying to make a quick return, then I'd advise you not to actually do that.